All right, hi everybody, welcome back to the channel, and let's get straight into it. Today I want to talk about three ETFs that are also known as dividend growth ETFs. Now, what I mean by that, when I say the term dividend growth, I'm referring to two things, but the second one is going to be more important. The first one is these ETFs, as you'll see the first one we're talking about here, ticker symbol is SCHD. But what I mean, using this as an example, is that over the long term, you should see some share price growth. So that's one aspect. But the other part of it is you should also see some dividend growth. Okay, so when we talk about dividend growth, for this one in particular, I'm looking back, let's say over the last 5 years, 10 years. I want to see a consistent growth in the amount of dividends that are being paid out. And when I refer to these ETFs, this is not important, right? So I'm not focusing on the yield. So the yield is initially what you're going to get when you put, let's say, $10,000 into one of these ETFs and you invest it. So, at that time you put $10,000 in times 0.0395 would be, let's say, almost $400 a year you would get on that $10,000 at roughly a 4% dividend yield. But the most important thing that we're referring to with these ETFs is the dividend growth. And so going over SCHD real quick, this is also known as the Schwab US Dividend Equity ETF. When we look at these dividends, we're going back, let's say, 10 years. Today's August 24th. Let's go to September of 2014. If we look at the dividends they were paying out back then, they were paying out roughly 25 cents. As you can see, over the course of that entire year, the dividends were 25 cents. Going back even further, you can check out the dividends going back to like 2011, a lot lower than they are today. And we're going to see exactly how much they've risen. Go up to, let's say, 2020. And now we're talking dividends in the 40 to 50 cent range. By the end of 2020, we have a nice 60 cent dividend being paid out. And then going into 2021 and so on, you can kind of see this gradual increase in the amount of dividends that are being paid out. And so that's exactly what I mean. And that's the second aspect of these dividend growth ETFs, is looking at the total growth in the amount of dividends that are being paid out. Now, if we look at these payment days, you can see that these are being paid out every quarter, pretty much, it looks like. So just making sure we have a dividend on 6/26. Now in 2023, it looks like the dividend payment frequency was a little bit, because I see we have a payment day of 6/26 and then 12/11. So that was like a 6-month gap in terms of the payment day. But as you can see, like going back from 3, 6, 9, 12, it looks like 3, 6, 9, 12, every 3 months, you can expect a dividend being paid out for this ETF historically, right? And so that's what we're referring to, though, is the total growth in the dividends. Sure, we want share price growth. That's kind of the other aspect of it, or the first part I talked about. This ETF since November of 2023 was down here at $66, and now we're at $83. And so we're also participating in some of the upside of the market. But the main goal is to get that income growth over time. So that's the first ETF, SCHD, or the Schwab US Dividend Equity ETF. And if we look at the expense ratio, you can see down here, according to finviz.com, the expense ratio is 0.06. Now, that's another reason I chose these ETFs, is because when it comes to expenses, we want to keep fees low. Those expenses can eat into our dividends, eat into our returns. So we want to keep those returns, or the expenses low. So that's going to be the overall gross expense ratio, basically the annual fees that you'll pay for investing in this ETF. So that's the first one. And if you can go onto their website. If you go to SCHD prospectus, or you can check out Schwab's website, it'll actually go over all of the different holdings. And in fact, there's a link right there if you see where it says all the different holdings and stuff. So maybe that's something we could go over real quick, and I don't really want this page here. Let me go back one more time. Schwab ETF prospectus, and let's see what comes up here. So we have view all holdings. Let's go ahead and view all the holdings on this ETF. We have Lockheed Martin, Home Depot, as you can see. Some of these companies you'll probably recognize: Coca-Cola, Texas Instruments, PepsiCo. So basically all the big dogs, all the large companies. We know Coca-Cola has been raising their dividend for several years, and that's kind of what this ETF is focused on, right? Is trying to get those high quality companies that are going to have that track record of paying out those dividends. So that's kind of a list there, as you can see, of some of the top holdings. US Bank Corp, I actually have a bank account with them. So one of the largest banks in the US, obviously. We have a lot of different banks on here, T. Rowe Price, financial institutions, Regions, they're in my area as well. Darden Restaurants, a lot of chains. I forget exactly, it might be Olive Garden is one of the restaurants under Darden Restaurants. But yeah, you can kind of go through the list and see what companies are actually part of that ETF. Once again, SCHD or the Schwab US Dividend Equity ETF. Next one we're going to talk about is the ProShares S&P 500 Dividend Aristocrats ETF. This one in particular is going to focus on dividend aristocrats. What that means is companies that have increased their dividends for at least 20 years consecutively. So, real quick, let's have the definition of a dividend aristocrat, just to confirm what this means. Dividend aristocrat definition. What is a dividend aristocrat? Just for confirmation. So this is a company, and I'm sorry, not 20 years, but 25 years. I said 20 in the beginning. So a dividend aristocrat is a company that has raised its dividends consistently for at least 25 years. So we should expect the dividends of Noble, NOBL, the ticker symbol, this ETF we're talking about, the ProShares S&P 500 Dividend Aristocrats ETF, we should see those consistent growth in dividends. And as you can see, over the long term, this ETF has done well. The share price has more than doubled in the last 10 years, roughly. So you're not only getting a share price increase, but you're also getting these dividends. Now, the dividend yield, like I said, don't focus on that, because it's more important in terms of the growth we're going to be getting. How much growth are we actually receiving from this ETF? Now, for some reason, it's kind of cut off here, but let me zoom in. There it is. So, $2.20 annual dividend, 2.13 dividend yield. Don't focus. I know it's tempting to just look at the yield, but let's go back once again, 10 years. Let's see how these dividends have fared. If we go back to 2014, September of 2014, so roughly 10 years ago, 21 cents was paid out, and we're looking at every 3 months in terms of those distributions, it looks like. So quarterly dividends once again. This dividend was 21 cents per share, cash dividend paid out. As we keep going into, let's say, 2019 would be roughly 5 years. You can see some variability in the dividends, but we're starting to grow. We're going from, let's say, 25 cents or 20 cents in dividends up to 35, 40 cents. So the dividends over the long term, you obviously have a large basket of companies, lots of different companies that they're trying to choose for those dividend aristocrats. But ideally, we see these dividends continue to go up, and that's what we've seen for the most part. And like I said, you're going to have some variability. Some months are only 35 cents. Some months you're getting 60 cents. But if we look back at the most recent numbers, now we're trading at 55, 60 cents roughly, let's say. And we have another dividend here for 38. And I'm not sure how they determine these distributions, to be honest. I'm not sure why there's so much variability. But if we go back, they were only paying in the teens roughly 10 years ago. So 20 cents, 19 cents. And so you're seeing, if we plotted this on a chart, you would be able to see, and maybe I should do that, just so you guys can see what I'm talking about here, and I'm sure you can kind of picture it in your mind. But if you're looking at dividends on a plot chart where it's like 19, 21, then you go down, go back up, but the overall trend is up, right? You can draw a line through the trend, and you can see that the trend is your friend in this case. And even though we do have a lot of variability in terms of these dividends, you are going to be receiving more and more, hopefully, over the long term. So only a 2% yield, but still steady dividend growth over the last 5-10 years. We're focusing specifically with this ETF, companies that have increased those dividends for 25 years or more consecutively. If we look at the expense ratio, the downside to this one, the expense ratio is a little bit higher. Now, 0.35 basis points is not a killer, but relative to the first one we talked about, SCHD, this one only has a 0.06 expense ratio. So that is something to consider. Look at the dividend history and look at the growth overall of the ETF and ask yourself, what's the total return? So we could kind of go over that maybe in another video comparing these ETFs. But you can also do this yourself. You can look at the dividends, you can calculate the returns on average and what they've been, even though technically past performance is not indicative of future success. But a lot of people I know are always looking at, past data, let's be honest. That's like a disclaimer on Wall Street. But the reality is, past performance can, in fact, in my opinion, be indicative of future success, because you can look at the trends, and typically the trend is your friend, especially when it comes to companies that are consistently paying out dividends. And even though some of these companies will not pay out these dividends forever, but nonetheless, if we look at the holdings real quick for this ETF, let's take a look and see what they're investing in. I think there might be some overlap with the companies in this ETF, but let's see if we can find specifically which companies this ETF is investing in. And in this case, we have, going down here, it looks like 66 holdings in total. So I think less than SCHD. But if we look at all the holdings here, taking a look at the specific weighting, as you can see, 1.52%. A well-diversified portfolio. We basically have, I think, pretty much all of the companies in the Dividend Aristocrats Index. So we have ExxonMobil, we have Kimberly-Clark, we have Caterpillar. So we have, Brown & Brown, the law firm. I actually did not know they were a Dividend Aristocrat. That's interesting. We have Johnson & Johnson, Coca-Cola, Realty Income is one I've talked about on the channel before as well. Walmart, big dog company. Sherwin-Williams, the paint company. Target, my wife likes to shop at Target a lot. So we have all the big dog companies. Clorox, obviously, people use their household products on a daily basis. And so there's a big competitive moat for these companies because of how established they are. And so that's what you're kind of looking for, right? They can also have that inflation hedge because people purchase their products on a regular basis. And so even if they do go up in price, yeah, you might see some lower demand temporarily. But over the long term, the idea is that these companies should fare okay. So that would be for the Noble ETF or the S&P 500 Dividend Aristocrats ETF. Let's go ahead and move on to the third one, and that is going to be, get out of these real quick. So we have the Vanguard Dividend Appreciation Index Fund, VIG. Over the last 5 years, as you can see, since 2019, $115 up to $193. Going over the max chart here, this ETF's actually been around since 2006. Last 10 years, though, we've more than doubled the share price. So, looking at the specific dividends paid out for this ETF, let's go back roughly 10 years. Let's see how this is done. We're looking at roughly, let's say, 40 cents. A bit more consistency with this one. The dividends aren't all over the place. We have a roughly, let's say, a 42, or let's call it a 40-cent dividend being paid out in 2014. If we go up to 2019, we're seeing some increases. Now, let's call it 50 cents roughly in terms of the dividend being paid out. If we go forward up until 2024, that's when we're really getting into these higher dividends. So now we're looking at dividends, let's call it on average of 80 cents per share. So we're going from, let's say, 40 cents, 50 cents, 60 cents, and a gradual increase. Once again, if you plotted this on a chart, you had different markers you're looking at. You might have some zigzag, but the overall trend is going to be upwards. And so that's what we want to see. In this case, it looks like the dividends that you're receiving have actually doubled. And the yield's only 1.86%. You might say, oh, that's total crap. I can go put that in a savings account and get 5%. Understood. Interest rates are expected to come down, though. And typically when interest rates come down, even though the market, you could argue, has been on a massive bull run and, how much more can there be, you'd be surprised. And I would say even with interest rates coming down and potentially additional liquidity going into the market, we could see an ETF like this do pretty well. But it just depends on a lot of factors. There's a lot of factors, and that's kind of getting into the macro, the Fed and all that kind of stuff. I like to focus on, long term, how can we create cash flow for our portfolio? In this case, Vanguard Dividend Appreciation ETF, VIG, 1.86% yield right now, but that's not important because those dividends, regardless of what yield you're buying this at, you might invest $10,000 and say, oh, that's only $180 versus the first ETF had almost a 4% yield we were talking about. So that's a big difference initially, but then when you have an income that's already doubled, right, and a share price that's doubled over the last 10 years, that's good. That's what you want, right? So your income's constantly increasing. And, there's two ways you can look at this. You can look at the initial yield, like I said, and we've talked about different ETFs like JEPQ and other covered call ETFs. I think those can absolutely have a portion in your portfolio as well, obviously depending on your specific risk tolerance and stuff. But if we look at these dividend growth ETFs, I honestly, I'm starting to like these types of ETFs more and more because you're getting the best of both worlds. You're having your cake and you're eating it too. You're getting the share price growth from, let's say, 150 to 193. You're investing in high quality companies that have been around for decades and most likely are going to continue to be around. And the other thing is you can also potentially sell covered calls and cash secured puts and do the wheel strategy against ETFs like this. So the wheel strategy is another way of generating income against your portfolio. I've talked a lot about that. I actually made a video on SPY options and potentially making $1,000 a week if you want to check that video out. It was one of my most recent videos I made. Looking at the share price, and then the expense ratio on this one is also the same as the first ETF we talked about. So that's good. We want to be able to have that low expense ratio, 0.06. And then we can also look at the holdings. So what is this ETF VIG actually investing in? What are the holdings for this ETF? Let's take a look real quick. So let this load, and we will go over specifically what holdings and what stocks this ETF is investing in. Because remember, when you invest in an ETF, really, in the case of these types of ETFs, you're investing in a large basket of companies. Let's see here. So as just a confirmation, expense ratio 0.06, have the market price, net asset value, and then you have the portfolio composition. So in this case, we have 339 companies. A lot more than the other ETF, Noble. That one only had, I think, 66 because it's specifically focused on those dividend aristocrat stocks. If we look at the sectors, you can look at those right there: financials, healthcare, energy, consumer staples. There probably will be some overlap once again, but the different weightings too. So in this case, Microsoft makes up 3.84% of the portfolio. Apple makes up almost 5%, 4.55% of the portfolio. So definitely more weight in this case towards those larger tech companies. Apple, Microsoft, Exxon Mobil. We've talked, I think that one is in all three of the ETFs because they are, they've been paying and raising their dividends for decades. MasterCard, Procter & Gamble, a lot of household products, Johnson & Johnson, basically all the big dogs, Broadcom, and you could go on. Go to the next page here and check out the next 10 companies. And as you'll see, the weight goes down as this continues right here, the percentage of the fund. So Home Depot, Walmart, that was another one, I think in the last ETF. Coca-Cola, I think that was in all three ETFs as well. Pepsi, right? So ask yourself, when you're choosing these ETFs, you could invest in all three of them. But there is that overlap with these companies. Different weights, obviously, but anyway, thank you so much for tuning in. Hope you guys learned something in this video. Just remember, when you're investing for dividend growth, you're investing for share price appreciation over the long term, and you're also investing for those dividends obviously growing over the long term. So in all three of these ETFs, we've seen that. And so regardless of how you go about it, you can absolutely make some very good income from these ETFs. And that's why I like to talk about this, because one thing that I really stress on this channel, especially with all these AI layoffs we're seeing and stuff like that, is taking control of your income sources, taking control of what you can control, right? That's one of the reasons, I love talking about this stuff on YouTube, but if I can make a few bucks on it, guys, if I can make some ad revenue, I think I'm making like $2 a day on ad revenue right now, which may seem like it's nothing. Who cares? It's only $2 a day. But for me, I'm thinking about this over the next 5 years. Do I want to be working for a corporation? There's still going to be a lot of opportunities, especially with all this machine learning stuff, but we're already seeing, AI and all this stuff happen. So these corporations, they're already established. They're going to have, I think, more ability to consolidate, job opportunities and power for themselves. And that's going to result in these companies most likely being able to increase those dividends over the long term. So then you can be a part owner and you can benefit from that, right? That's the beauty of capitalism. Yes, there's changes. There's a lot of stuff happening that you could argue is negative in the economy, but you have the power also to take control of your mind, of your emotions, and of your will. Basically being able to step out and create different income sources. And that's why I'm so passionate about helping people find these opportunities. And this is just another example of an income stream that you could potentially set up if you are able to invest some money every month, even if it's only $100 a month, $200 a month starting out, if that's all you can afford. I've had plenty of those months where I'm only able to put away $100, but I'm putting away something, right? I'm putting away something because I know that investors, those who invest and those who grow, whether it's a side hustle or a business, those are the people who, see the opportunity, right? So you got to change your mindset from just a 9 to 5, I'm going to go do my corporate job, to, looking at all the various opportunities out there. And with that being said, I digress. I'm kind of going down a rabbit hole here, but hope you enjoyed this video. Hope you learned something, and we'll see you in the next one. Take care, guys.